All right, today we're going to play detective. We are cracking open the books of a small business to solve a pretty common financial mystery. We're on the hunt for the real story behind the numbers, and I'll give you a hint. It has way less to do with the cash in the bank than you might think.
So let's just start with a really simple question. Imagine you get to the end of the year, you look at your business account, and there's $50,000 in there. Does that mean your profit is $50,000? I mean, it seems totally logical, right? Cash in the bank equals profit. But, as we're about to find out, that is a dangerously simple way to look at things.
So let's set the scene. Meet the owner of our fictional business, the Explainer Cafe. It's New Year's Eve, the very last day of the financial year. The books are about to close, and she's looking at that healthy cash balance. On the surface, man, this looks like a great year, a real reason to pop the champagne.
But is that cash balance the whole story? Not even close. It's just one piece of a much bigger, more complicated puzzle. And to see the whole thing, we have to do what accountants do. We have to make what are called year-end adjustments. The best way to think about these? They're like putting on a special pair of glasses that bring the true financial picture into sharp-accurate focus.
Okay, first up on our list, let's deal with the Unpaid Customer tab. This is all about money you've already earned, but, and this is the important part, you haven't actually received it yet.
So, the Explainer Cafe had a fantastic December. They landed this huge catering order for a local company. They delivered all the coffee and pastries, everything was great. But the company is going to pay the invoice in January. You see the problem? The sale happened this year, but the cash won't show up until next year.
In the accounting world, there's a name for this. It's called a trade receivable. It's just the official term for money that customers owe you. And yeah, it's definitely an asset. It has real value. But the key thing to remember here is that it's not cash you can go out and spend right now.
And this brings up a really critical risk of doing business on credit. I mean, what happens if that big client, or maybe some other smaller customers, just don't end up paying their bill? It happens.
This risk is so real, so fundamental, that there's a core accounting philosophy to deal with it. It's called the prudency concept, and it's all about anticipating probable future losses. In plain English, it just means being a realist, maybe even a little bit of a pessimist. You have to assume you won't collect every single dollar that people owe you.
So, how do we actually do that? Well, it's a pretty simple three-step process. First, you look at everyone who owes you money. Second, you make a realistic, educated guess of what portion might go unpaid, maybe based on past experience. And then, and this is the crucial part, you record that estimate as an expense for this year. This creates a little bucket called an allowance for doubtful receivables.
So why does this matter so much? Well, ultimately, it's about being honest with yourself and anyone looking at your books. By anticipating these potential losses, you stop yourself from overstating your assets and your profit. Your financial reports start to reflect reality, not just wishful thinking. You skip this step, and you could end up making huge business decisions based on money that's never actually going to arrive.
Okay, our second big adjustment is all about timing. Specifically, it's about making sure your costs are matched up to the correct financial period. This one's a biggie.
This is all governed by another absolute bedrock of accounting, the matching principle. The goal here is super simple. You want to line up your expenses with the revenues they hoped you generate. So, if you spent money to make a sale in December, that cost belongs on the books for December. It doesn't matter one bit when the cash actually leaves your bank account.
And here's a classic example. To get a nice little discount, the owner of the Explainer Cafe paid for January, February, and March's rent all at once, in late December. So the cash is gone this year, but the benefit of that rent payment, the actual use of the space, is for next year.
This is what accountants call a prepayment. You've simply paid an expense early. Now, because of that matching principle we just talked about, you absolutely cannot count all 3 months of rent as a December expense. Nope. Instead, only this year's portion of the rent belongs on the books now. The other 2 months? They become an asset called prepaid rent, and that'll turn into an expense as you use it up in the future.
Now let's look at the complete opposite problem. The cafe was crazy busy in December. You know, the holiday rush. Lights were on, the espresso machine was humming 24/7, ovens were baking nonstop. They used a ton of electricity. But the bill for all that December power won't actually show up in the mail until late January.
This is known as an accrued expense. You see, the cost was incurred in December to help generate all those December sales. So that matching principle demands that we account for it now, even though we don't have a bill in our hands. We have to estimate the cost and record it as an expense and a liability, which is money we owe, for the current year. Forgetting to do this is a classic way to get a really nasty surprise from the tax man later on.
All right, our third adjustment is a little more personal, but it's just as important. This is all about drawing a really clear, thick line between the business and the owner's personal life.
You know, the owner of the Explainer Cafe, she loves her own coffee. I mean, who wouldn't? So every single week, she takes a bag of those premium coffee beans home for her personal espresso machine. It's a super common perk for small business owners, but you got to account for it properly.
This is what's known in accounting as drawings. Anytime an owner takes goods or cash for their own personal use, it is not a business expense. It's not part of the cost of goods sold or anything like that. Instead, it gets recorded as a reduction of the owner's investment, their capital, in the business. And why is this so critical? It keeps the performance metrics of the actual business pure and untangled from the owner's personal life.
So, we've investigated the unpaid tabs, we've fixed all our timing issues, and we've drawn that clear line between what's business and what's personal. Now it is time for the big reveal. Let's see what the true picture looks like. All right, before we look at the final numbers, let's do a super quick recap of the adjustments we made. First, we accounted for the risk that some customers might not pay. Second, we corrected for that prepaid rent to match the expense to the right time period. Third, we recorded the electricity that the cafe used, even with the bill. And finally, we separated out the owner's personal coffee from actual business costs. And here it is, the impact of all that detective work. On the left, you've got that initial cash-based view where everything looked rosy. Revenue seemed high, expenses seemed low, and profit was, well, misleadingly optimistic. But after our adjustments, you look at the true picture on the right. Now we have a realistic, accurate, and fair view of how the cafe actually performed this year. Big difference, right?
You know, this brings us to a really famous saying in the accounting world. Cash is a fact, but profit is an opinion. And it's such a powerful idea. And that opinion, that profit figure, is only valuable when it's informed by these essential adjustments. They're literally the difference between just counting your cash and truly understanding the financial health of your business.
So the next time you look at a business, remember that the real story is written in the details, in its accruals, its prepayments, and its allowances, not just in its bank balance. Which really leaves us with one final question for you to think about. What untold stories are hiding in your books?